to a journey through the transformative world of microfinance, where financial services become a beacon of hope for the underserved and marginalized. Hi, I am Swapna, and today we are going to dive deeper into the world of microfinance. Let's start by understanding what microfinance is all about. Microfinance is the provision of fundamental financial services such as loans, savings account opening, and insurance to individuals with limited income. Commonly, professionals or individual enterprises face a lack of access to conventional lending facilities provided by major institutions. Gaining a comprehensive understanding of the fundamental principles of microfinance can facilitate your access to prompt financial aid. So, what exactly is microfinance? In the most simple words, microfinance is a financial service offered by several financial institutions to individuals or groups who are not included in conventional banking services. A number of microfinancing institutions provide modest fractions of working capital loans in forms of credits, microloans, or microcredits, referred to smaller segments of capital loans. There exist numerous microfinance institutions that offer individuals direct monetary transfers, insurance coverage, and savings accounts. The primary objective of these institutions is to offer financial services to women and impoverished individuals residing in rural regions, with the aim of facilitating the expansion of their enterprises. Through the provisions of savings account with no minimum balance and insurance is reduced rates and premiums, microfinance can benefit small enterprises, entrepreneurs, and even the household. In this video, we will explore how microfinance is not just a financial tool, but a powerful means to empower individuals, uplift communities, and drive economic growth. Microfinance acknowledges that individuals living in poverty possess extraordinary reserves of energy and cognitive abilities. The absence of financial services is not just indicative of poverty. It's an unexplored potential to establish marketplaces, attract individuals from periphery, and equip them with resources to support themselves. As former Secretary General of United Nations, Kofi Annan once said, microfinance recognizes that the poor are solution, not the problem. It believes in the dignity and capacity of the poor. Considering its vast geographical area and population, which is currently the largest in the world, the way economic growth is distributed in India has important implications for the dynamics of worldwide inequality. From 1960 to 2022, India's average income experienced a mean annual growth rate of 2.6% in real terms. However, this growth has been uneven and the disparity in income and wealth remains a significant challenge. This stark reality has compelled several institutions, including the United Nations, World Bank, and other non-governmental organizations, NGOs, to launch initiatives aimed at alleviating poverty. Among these initiatives, microfinance stands out as a pioneer instrument in global endeavors to reduce income disparity. Impoverishment persists in impacting billions of individuals worldwide. Microfinance is just one of the several instruments aimed at promoting poverty reduction. More precisely, microfinance caters to the needs of impoverished population for financial services. Historically, the impoverished has been precluded from accessing conventional financial services. However, by introducing inventive financial products like group lending, microfinance institutions have successfully tackled the difficulties associated with lending to the poor. These products, including microcredits, micro savings, insurance, and others, enable clients to uplift themselves and their families from poverty. Through collaboration with network organizations, microfinance investment vehicles, donors, and technical support providers, microfinance institutions strive to effectively engage the marginalized and promote their complete inclusion in global financial systems. The initiative has expanded from a small number of organizations catering to a limited number of clients to numerous microfinance institutions, effectively reaching hundreds of millions of individuals with low income worldwide. Let's take a closer look at the salient features of microfinance, especially in India. Approximately 99% of microfinance loans in India are extended to women belonging to low-income households. 98% of loans are offered through the Joint Liability Group, commonly known as JLG, lending model, where a group of customers, typically 5 to 10 in number, individually enter into the JLG to borrow funds and commit a supporting and repaying the loans in case borrowers within the group encounter repayment difficulties. This group approach enhances operational cost efficiency and applies social collateral to underwrite and mitigate the risks of defaults. Microfinance loans do not require collateral. Outflows resulting from the repayment of monthly loan obligations must not exceed 50% of the monthly family income. The microfinance sector has a varied supply side as it comprises around 194 lenders, including banks, small financing banks, NBFCs, MFIs, and NBFCs. The sector operates in around 632 districts across India, with 76% of the loan portfolio being rural and 24% being urban. Meet Chandana, who started a small weaving business with the help of a microfinance loan. Microfinance gave her the opportunity to start her own business. With the loan, she was able to buy materials and even the equipment. Now, she can support her family and have even hired a few women from her own village, providing employment opportunities. It's been life-changing. India's microfinance sector has a rich history and has undergone significant transformations. Let's take a break. Look at how it all started. India, like many other nations, established its modern microcredit or microfinance sector in 1990s, drawing inspiration from the Grameen Model developed by Professor Muhammad Yunus in Bangladesh. As this approach developed and achieved success, it enhanced the trust of clients, MFIs, and other stakeholders and began to expand. Between 2005 and 2006, some non-profit microfinance institutions transformed into for non-banking financial companies (NBFCs) and also new for-profit NBFCs ventured into the microcredit industry, attracting private investment, commercialization, professionalism, and expansion. Within a span of 5 years, the microcredit sector in India had a five-fold growth, resulting in an astonishing amount of almost rupees 20,000 crore. The Reserve Bank of India, or the Central Bank of India, established a new category of non-banking financial companies, NBFCs, known as NBFC MFIs in December 2011. These NBFCs are subject to unique laws that specifically target the microcredit sector and prioritize client security. Fueled by these rules, and industry enjoyed a remarkable, prosperous decade. Today, the microcredit industry is fragmented and fiercely competitive with more than 100 regulated participants, including banks, NFBs, NBFC MFIs, and NBFCs. The establishment of a well-defined regulatory framework, a robust underlying business model, consistent performance patterns over time, and the possibility of significant unmet demand have all drawn private investment to support the growth. Consequently, microcredit in India continues to be one of the greatest microcredit industry worldwide, unparalleled in terms of its extensive availability of inexpensive loans, enormous scale, diverse supply side, widespread convergence, effectiveness performance, customer protection, requirements, and involvement of the private sector. Microfinance is more than just providing loans. It's about empowering individuals, fostering entrepreneurship, and creating sustainable communities. As we have seen today, microfinance has the potential to transform lives and contribute to broader economic development. Thank you for joining us on this journey. Until next time, keep exploring and supporting the incredible aspect of microfinance.